Today's presentation is one that many of us have been looking forward to, and we're really excited to have a great panel of speakers today. The topic is employee ownership through employee stock option plans, or Esops. We did this did a similar presentation a couple of times in our history, and the steering committee had received a lot of feedback saying we'd like to know more about this, and we're fortunate to have Sue Crockett, and she is the executive director for the Minnesota Center for Employee Ownership, and she has put together a panel that includes Scott Grausnick and Kirk Lindemann, who are going to be the panelists and speakers as she takes us through this topic. I was talking with Diane during our breakout, and Sue, you have done a marvelous job of getting the word out and doing a great job on that. So we're really excited to have you and present, and I'll let you introduce Scott and Kirk, if you will, and take us away. Go ahead and share your screen. You should be available.
I will do that. Let me get to my PowerPoint. Okay, is that showing up?
There it is.
Yep. Okay, there it is. So thank you for that nice introduction, Mark, and thank you for the opportunity to be able to share information on employee ownership to your membership. That's great. And I see a lot of people that I already know. Hello, Diane. I had Kyla in my breakout room, BMO Bank. I see Jeff Campbell from Fidelity Bank. These are all people that are great supporters of the work we are doing. So we really appreciate that for sure. So let me tell you a little bit about me, and then about the what the work we're doing, and then about Scott and Kirk. So the Minnesota, let me see. Oh, why is my screen not advancing? This is not good.
You might have to click it.
Well, it should just go down. Oh, there we go. Okay. So first about me, Sue Crockett. I spent 30 years with the Esop Association as the executive director of the Minnesota and the South and North Dakota. So I've spent a lot of years in the Esop environment. And in 2020, the Employee Ownership Expansion Network, which is based out in Arlington, Virginia, started to create these state centers. And Minnesota was one of the second state centers to be created. And I came over as the executive director. There's now 7 more that are being created. And the whole purpose of us is to be the boots on the ground. There are different associations that are membership driven, and they serve the needs of their members. But ours is strictly down the middle and to be a hub of unbiased information, free unbiased information. We're not a membership driven organization. So we're not in competition with anyone. We just want to serve as that hub of information that we can help business owners and the advisors that serve them to know what the options are for them as they go forward. So that's there. So a little bit about the climate right now, and I'm sure you're all seeing it too. This slide shows that there's 2.34 million business owned by baby boomers. That's across the country. In Minnesota alone, there's 53,000 businesses that are owned by people over the age of 55. 60% of them do not have a succession plan, and 40% don't even know what their options are. So we all have our work cut out for us as far as how we're going to help them create a legacy, save the employees their jobs, and keep those businesses in their communities. So that's really what our work is about. And you can kind of see how this breaks down around the country of how the industries go in the US. So today we're going to talk about employee stock ownership plans, but the Center for Employee Ownership, we cover all forms of employee ownership. We're like I said, unbiased. And so we also can talk about worker-owned cooperatives and employee ownership trusts. So those are the three models that we, kind of help with or have information on, and can direct people to the professionals that serve those industries, and also to the stories like you're going to hear today from Scott. So today we'll focus on Esops. And I'm going to have each one of them introduce themselves. So first, we're going to have Kirk from Eide, and he has worked with Harbinger partners in helping them transition to their Esop. And I've known Kirk for a long time as well. And then Harbinger Partners is going to be Scott. And he was an owner that sold his business to an Esop, smaller, mid-sized company, which is usually a good fit for an Esop. And but he also stayed working in the company. So I think he has a unique story to tell. So let me start with Kirk, and he's going to talk about what is an Esop, and let him tell you a little bit about himself as well. Kirk, are you there?
Yeah, thank you. Thank you, Sue.
Sure.
Thank you, Mark and EPI, for the opportunity to get in front of this group. It's great personally. I'm an audit partner by trade. Do a lot of consulting work on the with ESOPs and employee-owned companies. So it's good coming out of busy season and getting into something that's not debits and credits. You're not going to see journal entries on any of the presentations, so you can rest easy. We're just going to talk about employee ownership, kind of at a high level. Some of the things we're seeing from our firm, like Sue said, I'm with Eide Bailey, regional national accounting firm, advisory, audit, tax. So give a little background on some of our clients, on what they're seeing, what their options are, and then the exciting part is we're going to get to Scott, and he's gonna tell the story of Harbinger Partners, which is a really cool story, and we're very happy that we were a part of that transaction and their transition to employee ownership. So should I jump into it, or Scott, do you want to introduce yourself quick?
I'll wait, Kirk. We'll save the excitement for just a few minutes. I don't want to.
That's right. It's 5:30 where you're at, right?
Let it build up.
Right there.
Okay. So before you move on, Kirk, I meant to mention this, that if you have questions, please put them in the chat room. I think Mark's going to monitor that for us, and we will pause every once in a while for questions, but we'd really like to make this very interactive and, more have you engaged with it. And because I know you're all kind of in these areas, and we want to make sure that you get the value that you want for it. Also, I understand we've created a PDF of this presentation, so that will be available to you as well. And I believe that Jessica's recording it, and that will be available after the session as well. So now I will move the slide and let Kirk go ahead. We'll let Kirk do that. Okay, go, Kirk.
Okay, first off, I apologize. Most of you are probably familiar with ESOPs and employee stock ownership plans, but I do want to touch on a couple things at a real high level here, just for those of you who maybe aren't as familiar with employee ownership and ESOPs. ESOP, obviously, we've talked about it already a little bit. Some of the unique things and common things to other employee retirement plans are they have to follow federal law, right? So that brings in the DOL, the IRS, ERISA, all those fun governmental agencies. So we'll maybe talk about that in a little bit too on a potential other considerations when considering employee ownership or an ESOP. They are a qualified retirement plan, right? So tax deductible contributions for the employer and tax deferred growth for the employees. The key takeaway, I guess, from this slide is that employees typically don't use their own money for this type of retirement plan, which is a really cool option, right? You hear these stories for employee-owned companies where the front desk clerk retired with $1 million and none of it was put in by her. It was all company funded. So a real unique option compared to other employee benefit plans. Now there is KSOPs out there as well, which does require kind of both the employee deferred contributions as well as employer, but we're just going to focus maybe on just straight ESOPs today. Next slide. Okay, so here's just a little background. I'm not going to get into this a whole lot, but it is relevant to the group that's attending today and advisors. You'll see the spread of employee-owned companies and ESOPs throughout the nation. This is a little bit older slide, but if you see in the Midwest, you see Minnesota over there. It's top 3 of kind of that Midwest. So there's plenty of activity in Minnesota, North Dakota, and the surrounding areas. We'll call it the Midwest, really all over. And as this group has probably seen, that traction just continues. There's several opportunities with employee-owned companies to help transition client businesses. And ESOPs aren't for everyone. I'm not here to tell you that it's a perfect fit for every company and every business owner, but it is an option, and it's going to grow in popularity. I think we've just really hit the tip of the iceberg. And with new administration coming in, there's a lot of changes that could benefit the employee ownership and ESOPs. So just kind of a lay of the landscape, and we'll talk about industry on the next slide here. Just give you a little background on industries that are popular with employee-owned companies, and really the meaning of this slide is just to say that all industries really are a pretty good fit for an ESOP or employee ownership to look at. So there's some that are a little more regulated and might not allow, some of the employee ownership, but on a broad level, on a broad statement, I would say that there's a lot of different companies that would be good fits for employee ownership. The general landscape, like I said, is pretty good economically and politically. As Sue and Steve are aware, there's tons of state centers popping up all over the place, increasing nationally in popularity, education, really garnering a lot of federal and state support. The broad-based ownership support is throughout the country. So that's really good to see. I don't know that we could have said that 10 years ago, or maybe even 5 years ago. There was always some questions on kind of what these ESOPs were, and are they good for companies and workers? And I think the answer has been a resounding yes, and they're growing in popularity.
Yeah.
Okay, Sue, next slide. So I won't go through all this in great detail, but I just want to hit a couple points here. The business succession strategy, you're all aware that this is an option. A few things, the lower stress ownership transfer method, as compared to like a private equity or strategic buyer. In an ESOP, really the owners and management all stay in place. You're kind of selling to yourself, right? There's obviously some procedures and protocol that you have to go through, but your buyer essentially, because a lot of that is not going to change. So it's a little bit lower. If there is such thing as a low stress ownership transfer method, this might be one of them. Kind of talked about it already. Management doesn't have to change, and the shareholders can still maintain amount of control and really total control for the most part, depending on kind of the board makeup. But also in this, with this succession strategy, it doesn't have to be 100%, right? You don't have to sell 100% of your stock as a business owner to the ESOP. There's varying degrees, and it all comes down to kind of what makes sense for the selling shareholders. The fractured ownership, the next one, we've seen companies that come to us with a lot of different minority owners, and they want a consolidation and really give everybody a piece of the pie and to participate in the company growth and the ESOP. I don't know if Scott would say he's slowing down, but he didn't retire, so I think he's still getting after it pretty good. But yeah, a lot of owners stay in the business, and the transaction sometimes requires key management and owners to stay in the business to a certain degree. And just differences between strategic and private equity. I would say the key kind of takeaway from that last line item is, ESOPs have to go through due diligence, and fair market value is a term that you would hear quite a bit in a transaction. Basically, no goodwill, no blue sky, which there could be in some of these other transaction structures. Now, I would argue that an ESOP can be very competitive. An ESOP transaction can be very competitive with some of these other structures if structured right, with potentially synthetic equity and some warrants and SARs and some of the very popular vehicles that are used. Next slide, please. Okay, we'll just go through some of the benefits and then some other potential considerations here. You're going to hear tax treatment quite a bit, and then the maintaining of company culture. Those are really two of the key areas that a lot of our prospective ESOPs come to us with. Hey, we love our employees. I want to reward them. What's the best way to do it? And oh, by the way, we can do it. We can do it tax advantageous. Yeah, I want to hear more. So those are kind of the two driving factors why companies come to us or think about the ESOP route. So let's get into some of these. Sue, on the next slide. And I'm probably not telling anybody anything they don't know in this space, but just hit on a few key areas here. You know, I talked about this already. It's kind of a low stress transition because the sale, it really, the ESOP creates a market to sell the shares, right? You don't have to go out to private equity. You don't have to go out to strategic and really sell, really sell your company. You have the people intact and you have a profitable growing company. It really just creates a vehicle to get that stock over to the ESOP. You know, the capital gains treatment, you're going to hear that quite a bit through any ESOP transaction because it is a sale of stock. The ESOP is required to buy stock, and there's the comparison between stock sale and asset sale. I think I mentioned this a little bit, can sell all or part of their shares. It doesn't have to be 100%. I would say there's a certain threshold that makes sense from an administrative cost perspective where that might need to be considered, but doesn't have to be 100% all the time. There's some other tax advantages with seller notes. Most of these transactions, I would say, aren't 100% cash. I would say actually very few transactions are 100% kind of cash out. There's going to be some seller carryback or seller financing involved in the process. So a little bit of bank financing and some seller financing as well, and that would qualify for installment sale treatment from the tax side of things. You know, the one thing that we really key on in these transactions is that last line item, you know, unique one-time opportunity to sell to a tax-exempt stock buyer. Basically what that means is in the year of transition or transaction, there's a lot of planning opportunities on the tax side that will basically go away the next year. In 100% S Corp ESOP structure, that S Corp is owned by the ESOP trust post-transaction. So just simple things like depreciation acceleration in the year of the transaction, it'll reverse the next year and recapture to a tax exempt organization. So the seller on the way out can capitalize and optimize a lot of the taxes in the year of the transaction, which is super important. And Scott can maybe talk to a little bit of that. We try and go through and plan as the best we can to optimize taxes on all these transactions. Let's go to the next slide, Sue. And yeah, and taxes are important, but I would say probably the main benefit or the main reason that sellers and companies are looking at this is this slide, the company culture. You know, the employee workforce, the recruiting, retention, presence in the community, all of that is super important. And that's when companies approach us, we usually start with this. And if they're passionate about this part, they're usually a good fit for employee ownership in an ESOP. And that was what was so fun about the Harbinger transaction is Scott already had an ESOP. His company operated like an employee-owned company. It just didn't say ESOP behind it. A lot of buy-in from employees and doing looking at things the right way. You know, looking at rewarding employees for their commitment, for their tenure, and basically growing the company. You know, the recruiting aspect. I tell this story. Back in the oil boom, there was service companies out in Western North Dakota that were looking to transition to ESOP strictly for the recruiting aspect. Like workers went out there and that was their question is, hey, do you have an ESOP? So it was kind of unique that an area or an industry that you might not think really fits the employee ownership structure or kind of mantra was still looking at some of those options. And we actually worked on a couple that went that way for the right reasons, but retention was key there. And obviously everybody's fighting for great employees, and any little arrow in your quiver with that these days, I think goes a long ways, as you guys are aware. Let's go to the next one, Sue. Tax advantages again. I touched on this a little bit in the 100% S corp structure. The trust is exempt from federal income tax and most states as well, North Dakota and Minnesota, including. Going forward, the company will not pay tax. So if there's leverage on the original transaction to the seller, back to the seller or the bank, the company can take those profits and essentially pay back that debt tax free, because the ESOP trust is getting taxed on that, not the company, and there's no tax paid there in the S corp environment. There's a unique tax deferral technique with what's called the 1042 rollover. This only applies to C corporations. Really powerful in certain circumstances where maybe sellers don't need a whole lot of money cash out, or there's opportunities to get proceeds and reinvest in qualified securities. So very powerful. You basically defer the gains if you invest in those qualified securities. There's a lot more to this 1042, so a lot of details that we probably won't get into. I will hit on this too, and there was some discussion on potentially allowing S corps to qualify for the 1042. So if that was to happen, that would be a huge benefit for the ESOP world and employee ownership. Right now, that currently isn't available. There's a lot of discussion on different things at that level. And then as an acquisition, we have companies that once they become employee owned, they're a unique buyer of other companies, right? So they can go and acquire entities where the selling shareholders selling stock and not assets, like some of the other offers they might be getting. So maybe gives them a little leg up, asset versus stock sale on acquiring other companies. This is probably where I should put a disclaimer out there too and say, I am an audit guy, but I know enough tax to be dangerous. So any of you tax guys out there, if you don't call me to the carpet totally, but you can certainly point out things that don't make sense. So, but been through enough of these transactions, and there's some resources that are pretty good. So I think I'm displaying the right message here. Let's go on to the next slide, Sue. Yeah, so here's considerations. I told Sue I usually leave this slide off when I'm presenting the benefits and talking about ESOPs, but it is, and she agreed, it is relevant to keep this on there. It's not for everyone, right? We talked about the requirements up top there, and some of those are pretty not onerous requirements, but there's a lot of legwork to get to do the right thing, which is also the beauty of employee ownership. The costs are going to be there. This can range so broadly, but I would say if you have all the service providers involved that the Department of Labor would want you to, these are probably good numbers. Repurchase obligations, I'll talk, that's nowhere on a balance sheet, nowhere in an audited financial statement on what that is. Basically what that is the participant balances that are building up over time. The company has to fund those. So it's not like those participants don't get those $1 million payouts by just strictly being in the plan. The company has to be profitable and fund those as well. Corporate governance, fiduciary responsibilities. This has really probably loosened up a little bit too over the years. A lot of companies say, well, I don't want to lose control and somebody else is going to run my company, and that couldn't be farther from the truth from a lot of the employee-owned companies we work with. It's really the trustees and the fiduciaries and the board members work with the company, right? They bought the company knowing that it was profitable and had a lot of future forecasted growth and whatnot, and it was a great company. The last thing they want to do is change that. So there is some discussion with some of those board members and fiduciaries, but all in all, I would say it's just a consideration, not a deal breaker by any means. And then there's typically some guarantees on some of the financing with the debt, which isn't probably surprising in today's environment, but probably no different than any other structure.
Kirk, can you talk a little bit about the negative balance sheet equity? sometimes people have a hard time understanding how do you pay out immediately if somebody retires, or how does that work in the early going?
Yeah, so I put this in there, and I apologize. Thanks, Mark, for pointing that out. This is really for to make sure that if we're going through these transactions, to educate banks, bonding companies, whatnot, because if you think of a transaction, right, the equity value of the company, if it's sold 100%, you're going to bring in debt, whether that's seller financing or bank financing or cash outlay. It's going to reduce the company value, and sometimes, most often, it goes negative, right? So you have a negative balance sheet, negative equity. You'll go 1 year with a very healthy equity section, and the next year it's negative. So more of just kind of a heads up there from a financial statement presentation, into your question, Mark, into kind of we'll call it the participants taking distributions and all that right away. Not necessarily a huge factor, because there's vesting provisions with the plans, and things that don't allow them that value to be really huge in year one. Plus, the value of the company is very low. So you have a low value in the participant balance and not fully vested. So there isn't, year one, you're not going to have to come up with a bunch of cash and borrow a bunch more, I guess, is probably the 10,000-foot view.
Thank you.
Yep. Okay, so let's go to the next one. Just for the group, and this is kind of a little checklist we follow on prospective clients and prospects that are looking at an employee ownership. There's a lot of education. There's a lot of education that goes into the initial conversation. The shareholder goals are key. I mean, it's all great. The conversation usually goes the right way, and then you start talking value, and they have a different value in mind than maybe their forecast and or historical support. So we go through that quite a bit, and value is key. We want to make sure that everybody's on the same page there before we go forward with really any of this process, really any of the process here. But seller expectations and value. Let's go to the next one. I can give Scott a little time to talk here. Just roles in the Esop transaction. On the kind of the headline from this is process is key. Like I mentioned, this is much different than 5-10 years ago, where there was maybe a lot of internal trustees and maybe not transactional trustees. We don't see much of those anymore, and due to various things with the Department of Labor looking at some of these transactions. So this also supports kind of those cost numbers that I talked about in the considerations, and Scott can maybe go into that some if he wants to, but there's a lot of different eyes looking at these transactions, and that's, in my opinion, that's why they've really been cleaned up and really got a good reputation kind of going forward. We'll call it from 5 to 10 years ago. So a very viable option if done right. And every transaction doesn't have to have this, right? If there's other mitigating processes and controls in place, that's great. But typically in a larger transaction, we would have probably all these individuals involved.
Well,
okay.
So before we move on to Scott, let's take a couple of minutes and see if there's any questions or anything the audience would like to discuss.
Yeah, there's one that came in, Sue, that says, are there tax and legal timelines to be aware of to successfully implement an ESOP exit strategy?
Yeah, that more so on the tax, I would say. There's certain filings, and yes, there is, depending on the structure, there's sometimes some legal filings that have to be done. But I would say the tax deadline is probably more important on a lot of these filings than some of the legal things. Just kind of a broad-based comment. We see these transactions taking anywhere from 3 to 6 months, and typically not crossing over year end, just to have everything clean at year end so that taxes line up and all the filings line up. But sometimes they do cross over. So I would say if you're crossing over a tax deadline, that yes, you should look into some of those filings and deadlines that exist.
Sure. And then one other question that came in was what is the typical profile of a business who has just formed an ESOP? What you know, I think that there's this idea that they have to be very large companies, and there's a shift to that this can actually be done in a smaller company. What is that profile?
Yeah, and that's a little bit of a tricky question, and Sue, you can maybe jump in here too, but you know, there has to be a cost benefit of this. There has to be a significant employee base for the structure to work the way it's designed. And I hate to throw numbers out there, but just broadly, I would say you probably need at least 20 employees and, you know, maybe $2 million worth of worth. And I would say that's probably low end, but keep in mind, there's a lot of costs that go on annually after that, right? So that 25,000 to, you know, plus those annual costs might have an impact on the decision for a company that size. But anything's possible. There's unique circumstances to every company. But Sue, I don't know if you have any comments there.
Well, I was just going to say, I agree with you. I mean, I think at least, you know, 20 is what we usually say too. And if it's under 20, then maybe that's where the worker-owned cooperative comes in. Same concept that the owner can sell, fair market value, they can stay working there. The only difference is that then the employees are profiting from working there at the time, where the ESOP is a retirement plan. So there's a big difference. And Scott's going to talk about the size of his company. And I would say most of the ESOPs, and Kirk, tell me what you think, are mid-size. I know there's some larger ones. In fact, Burns McDonald, which has 6,000, you know, employees. And so it's unusual for them to be that large, but certainly can work at any level, but mid-size.
And then the last question before we move on to Scott is you know, valuations at the center of all exit strategies. And Kyla is asking, how is that determined, the value, and how would that compare to, you know, an auction process or some other way of market determination?
Yeah, that's a great question, and I'm sure some of you are familiar with how these are valued. Really what the ESOP trustee is buying is future cash flows. So discounted cash flow method is one method that's used in the valuation, you know, in combination with some of their historical financial results. There's a market value consideration and then book value. And what, I'm not a valuation expert by any means, but what we see when our group does that valuation is there's a happy medium, right, to achievability and feasibility. And really that value really coincides with kind of debt service going forward too, whether the company can service that debt for that value. So there's a lot of different levers that are being pulled there to get that kind of sweet spot. But compared to some of these other ones, we've had ESOP deals straight up that compare to private equity. Now that doesn't happen all the time, but I just would caution that not to assume that you're never going to get that full value. It might not come all in cash, but the value can be very competitive.
Great, thank you.
So should we move on to Scott? And we're going to have to give him credit because he's working from Arizona and had to get up at 4 a.m. this morning. So hopefully he's still awake and ready to go.
Thank you, Scott.
Are you there?
Thank you, Sue. And actually, that was when you asked me to present. I was honored. So I'm really excited to be here, first of all. But the other piece of it, which was a little bit funny, is I'm not a morning person. So I'm like, all right, doesn't sound so bad. And then all of a sudden I'm like, okay, 6:45, an hour earlier. And then you guys flipped your clocks and I'm like, wow, all right, I guess I'm really getting up at 4:30 or 5. So I have presented at conferences and big events before, and I've talked about culture. So I love culture. And to me, the ESOP is all about culture. So one thing is it's easy if you've got an audience because you can get to know them. You can see them, you know, you can see with their hands crossed or if they're sleeping, but it's a little harder this way. So I'll give you a little background to myself, you guys. I grew up in a little lake in Shoreview called Turtle Lake. I've lived there all my life. I still live on that lake, except in the winter times, I wander off to Tucson. I'm not a big winter fan anymore. So I'll wander back in a couple of weeks. I love any kind of sport. I've grown into the old men's sports now, which are pickleball and golf. So I've kind of graduated to being an old man, unfortunately. I've got a pontoon boat, pickleball, and golf. So I think I qualify for an old person. Went to IBM after my college career, successful years there, started a company and sold that in the 90s, and then started Harbinger in 99. Even though I'm the founder and president, my official title, if you ever get an email from me, is the Director of Delight. And my role, I expect with my clients and my employees, is to delight them. So I changed that probably 10 years ago, and it's just a fun thing. I like fun titles. So Harbinger Partners, we're an IT staffing firm, you guys. We do consulting and staffing. We've got offices in Nebraska and Omaha. And actually, we don't have offices. So we started as a virtual business in 99. And I believe that I've talked on building virtual businesses as well for 20 years. And last year, I believe that finally everyone started to listen to me. So sometime about late first quarter last year, it seemed like all of a sudden I was making headway to companies going virtually. And I just think it was eerie timing that there was a pandemic around the world. I think that had nothing to do with it. I think people finally, I'm taking credit for it one way or the other. So we have about 42 employees and about that many subcontractors. And then outside of consultings, we do staffing, we do permanent placement work. So I'll go into the culture a little bit later, but one of the things I'm most proud on is that we're the only 16-time winner of Great Places to Work in the Twin Cities. So that's been probably one of my proudest accomplishments. So next slide, Sue. Let's see, a favorite topic is culture. So if we look at culture, there's some foundations that you have to build on. Culture is number one. Everything needs to revolve around an employee being delighted. So in order to delight them, I think you need to look at the benefits that you're offering them. And as an employee and an owner, I want to exceed that. So if you look at benefits, I take compensation off the table. I overpay everyone, and not by a gross amount of money, but I believe if compensation isn't something to worry about, then you're safe. Benefits, you have to have as good of benefits as your competitor. Managed time off, we don't track time off at all. We have unlimited time off. We've never had an issue with it in 20 years. And then everybody is self-directed. We have no management structure within our company. So other perks we have, we do a long weekend up at Grandview. I allow them to come to my home for a week every year in Arizona. And then we do anniversary gifts and bonuses and just other fun things. So as Kirk alluded to, we started the employee ownership when I started the company in 99. I allowed people to write a check and buy stock in the company. And when I launched the ESOP, I didn't know what an ESOP was. When I launched the ESOP, some of those employees, my 3 admin people, for example, have been with me for 20 years. When we launched the ESOP, they all invested, and it was a big amount of money for them 20 years ago, somewhere around $3,000 or $4,000. They all cashed out for 6 figures when we launched the ESOP. And that was probably the coolest moment for me, that these people trusted me with a large amount of money to themselves. And when we launched the ESOP, they all cashed out. So next slide. We've had success. I mentioned the 16-time Great Places to Work. We've won other awards. And if you look at this, is a topic I've talked about before. I'm just going to drop it in here because it's important to understand as business owners here that if you look at the United States, the highest statistical number of employees that are disengaged from their work, which is 73%, and that number is getting worse. I thought maybe it would get better with the pandemic and the work from home. Actually, people are more stressed and they're working harder and they're working longer hours and they're more disengaged. So good for a staffing firm because right now everybody's looking and moving jobs and people and companies are hiring and replacing people. But it's really, really expensive from an employer standpoint. So I would encourage you, heaven help you, make sure that your employees are engaged in your business. Make sure that they're happy. And if they're happy, they'll be healthy. If they're healthy, they'll be productive. There's just so many benefits that come from engaged employees. So I could go on forever about that, but engaging your employees is all about building culture. Building culture ties right back to the ESOP. And now if you go forward, Sue, we can talk about ESOP a little bit. How did we get to the ESOP? So about 3 years ago, I started to do some estate planning. I hit that age where I was getting old. And so I said, well, I better figure this out. What am I going to do with my company, with my kids, with my wife, and everything that I have? And I had a really cool option set up with life insurance. So if I died, the company bought me out of my ownership in the business and gave my family a large amount of money. Well, the option of dying isn't the funnest option for me from a transitional planning standpoint. So for those of you who are planning on that, I'd probably reconsider the death part. I don't think my family knew exactly how that worked, or I'm guessing that there might have been an accident, and I probably wouldn't be here to talk to you today. They would have made it look like an accident, but I took that out of the equation. So if I die, they don't get my money anymore. So they still do, but it's different. Or sell the company. So selling the company, for those of you that have created a company, it's like selling your baby. I did it one time and it just broke my heart. I really did not like selling my company back in the 90s. And it went like most companies. They lost the culture. They focused on the bottom line. They did all the things that I really didn't want to do. And then all of a sudden I learned about an ESOP and I'm like, oh my goodness, I love employee ownership. I love culture. I love everything about an ESOP. This is perfect for me. So go ahead to the next slide, Sue. So I'll pause there. Mark, was there a question? I know one came through, but I didn't read it. Is that something I should tackle now, do you think?
I think we can wait on that one. Yeah.
Okay. So we created an ESOP team, you guys. I put together 3 of my team. I brought some myself, my HR person who'd been with me for, at that point, 17 years, all 7, and then my finance person. So, and then we went and interviewed a number of people who could help us. So we interviewed about 6 companies to work with on ESOPs. It took about 3 months to go through that interview process. There's some great companies out there. Kirk, so you know that you've got really good competitors. And the hard part with me is a lot of the competing companies were friends of mine. I knew people at Taj. I knew people at all the other companies that were ESOP companies. I knew a lot of the people there. Interestingly enough, I did not know anyone at Eide Bailey. And interestingly enough, independently, all 3 of us on this team came up with Eide Bailey as our top person to pick as our advisor for this ESOP transaction. So the point of that is, don't be in a hurry to pick that advisor for yourselves, you guys. That person in Kirk, it is Kirk in this instance. And if he wasn't on this, in fact, I've gotten to know him well enough that I'd probably say nicer things if he wasn't on this call. They were really, really, really good. I mean, they were from the very beginning until now, I considered them friends and they took care of us. And it's kind of like, I like working with small neighborhood banks, and they're kind of like a small neighborhood bank. So Kirk was great. He introduced us to Bart. Bart was our legal representation. His company is called Atlas Legal. Then in fact, they moved us to an independent trustee, and that was Alaris. So they're responsible for the sell side of the company. And then they introduced us to a person who would do the valuation. That was Aaron from Aclaro. So, and then there's another legal company, that's the trustee legal company. So there's a lot of moving parts to this. So from my perspective, it's fairly complex. So as you're assembling a team, complexity isn't one of the things I do well with. The good news is my 2 cohorts who have been with me for 20 years are very anal and very attentive to detail. So they were great with this. So the complexity didn't scare them. They did really well with this. And with a trusted advisor, which was Eide Bailey and Kirk and his team, it was much simpler. The cost was pretty staggering for a small business, and I don't mean to scare people, but it was right around $200 to $250, and that's thousands of dollars. I guess $200 to $250,000. I knew that going in, and it was right on that number. So it wasn't like they said it's going to be 200 and it was 400. They were pretty much right on the number. So my advice would be, if you go the ESOP route, find people who you like first of all, and then find people that you trust, because you're going to be getting to know them really, really well. I think that's about it on that particular slide, Sue, if you want to slide that forward. If I reflect, is there something that I was surprised by? I would say the sheer complexity of the transaction. I think part of that is you've got the Department of Labor in here, and they, I think I'm probably not really a pro-government person, so not to get into politics, but whenever politics or government gets involved in business, I don't think it typically goes really smoothly. And I would say the Department of Labor is not an exception to that. So having people that have done this a lot of times and can kind of keep them out of the way and know all of the different things that are going to come back and potentially get you is really important. So it is a complex transaction, but surrounding yourself with great people is really important. So the one thing that was interesting that I didn't know at that time is there's a buy side and a sell side. So, and I'm on both sides of this transaction. So myself as the primary owner and the president and the founder am selling the company back to myself and my employees. So you've got this group of people over here on the right side that are selling the company that I'm working with and doing all kinds of work. And there are these people on the left side who are buying the company, and I'm doing this work and providing them information. And then the two of them negotiate a little bit, and then they come back, and then they negotiate a little bit, and then they come back. So that was probably a surprise to me. I didn't understand that, but now that I do, I'm like, okay, it makes sense. You know, when the Department of Labor comes in and audits us, if they do, we want to make sure that we did our due diligence, and they did their due diligence. And the only other thing that I would reflect upon, and Kirk and his team were great with this, I have other buddies who have set up Esops and they missed out on this piece of it. But I would encourage you to understand what warrants are. They're a huge deal. You don't want to miss out on that. I didn't really understand what a warrant is. I'm not sure that I did. So I'm going to read what Kirk gave me. A warrant is an opportunity for me to provide a market return for carrying substantially all the debt from the transaction. Think of it as additional interest, only you will get capital gains treatment when the warrant becomes due, which is when the debt gets paid off. So if you look at the ESOP transaction, I probably sold my company at a little bit of a discount to the employees. I've heard anything from 10 to 20% less than market value. However, I get to still run my business. I love it. And I'm going to make up for that times 10 on the warrant side, on the back side of this. The warrants are really, really important. So if you don't get anything else out of this presentation that I did, warrants are huge. Next slide, Sue. Lessons. First and foremost, pick a team that you are comfortable with. They all cost the same amount of money, you guys. You're not going to get a discount on anything with this whole transaction. And so I would encourage you not to shop it. Pick somebody that you really, really like and that you really trust. Secondly, make sure you build in some bank debt. We did not need bank debt in order to do this. I wanted to take the debt all myself. Because of the warrants, I took on bank debt, which was really important. And then the last piece of it, make sure you structure your debt conservatively. In other words, you don't want to bankrupt your company in the first couple of years. It's really difficult as a business to all of a sudden take on this large amount of debt and run it. So I structured the debt very conservatively. I gave my employees a year vesting for the previous year that we went. I did everything that favored the employee side of this. So I love doing that because I think it's all, at the end of the day, it's taking care of your employees and building a great culture. And then the only other parting piece of this that I give you is that make sure you educate your employees, because when they look at this and how exciting it is, and there's all this enthusiasm and they get their ESOP statement in the first year, there is no value. And the reason there is no value, Kirk, this is probably a terrible analogy, but it's one that makes sense to my employees. But if I go out and buy a house and the house is $100,000 and I put debt of $100,000 on my house, in a year, if my house value is still $100,000 and my debt is still $100,000, I have no equity in my home. That's easy for them to understand, similar to my business. Now, in a year or two, if the value of my house goes up to $120,000, which means I grow my business and I pay off some of my debt, I've got equity in there. And now my ESOP looks like it has some value. So make sure your employees understand, gosh, Scott sold me a bill of goods. I got my ESOP statement and it's $35.86 after a year. And it could be a really low number. Make sure you understand this is not a short-term win. This is a long-term play. And if they can stay with you, and most of my employees, 50% of my employees have been with me for more than 10 years. So it's a way to keep your employees and to keep them happy. And
you know, Scott, can I just ask
Yep.
one more time about your culture? Because you've talked about, that's a theme I hear in your remarks, and you started off by saying we have unlimited time off, we have
Yes.
no management structure. Is that what you said?
I did say that, yes.
And what was the third? Was there another thing?
Unlimited time off. We have great benefits, and we take the compensation off the table, Mark. I just believe, you know, if you're skimping on comp isn't usually a reason a person will leave a company.
Yeah.
But they're going to leave a company when somebody pays them more money. Take it off the table. It shouldn't even be a top. Pay them 5 or 10% more. They're not even going to look. That's a really easy one. Benefits are really easy. Some of the other fuzzy, warm things, unlimited time off is actually pretty easy once you go down that road and you pay them for performance. I don't care if my people are going to the gym at noon. I don't care if they're going for a dog walk at 2 p.m. We're virtual. I don't even know what they're doing, but I know they're doing their job. I think our whole country will get to pay for performance at some point. We're just not quite there yet, but we're going to get closer with the virtual workforce.
And so by paying 5 or 10% above market rates, if you will, and you know, all these benefits that go with that, you're actually getting more productivity and a better culture and healthier employees, and that pays dividends when you're doing the ESOP. Is that what you're saying?
Absolutely. Yeah. You want them engaged. I mean, however you can figure out how to engage your employees. You know, I think we all think we're different and better, but when you look at a statistic that says more than half of your employees are not engaged, you need to just do some self-reflection, say, okay, I need to fix some things. Let's say I'm better than most. That still leaves 30 or 40%. So all of us can improve. I can do better too.
Sure. Well, this has been great. There's been a couple questions that have come in on this concept of warrants, and I think everybody, you know, maybe has heard of warrants, and they don't really understand them. And I think you had a good explanation of it, but there were some details too, Kirk, and maybe you want to chime in on how the use of warrants is as a way of crafting this transaction. Can you speak a little bit more about that, you two?
Yeah, I think the easiest way to explain a warrant is really compared to a stock option, right? With a strike price, and anything that gets above that strike price, if that seller debt is paid off, that's the difference that the selling shareholder is gonna capture for income. So the reason they're structured like that is, let's just say in an original transaction that Scott says, hey, my company is worth X. And if I went out on the open market, you know, I could maybe get, you know, 10% internal rate of return on that. So he would take a seller note at 5%, and that gap between the internal rate of return and what the rate on his seller note is 5%. We kind of built that into the feasibility structure into these warrants. So if the company performs, he gets a second bite at the apple, and he's really betting on himself, what those stock options / warrants are representing. But it's to get him fair internal rate of return for his company on a grant, you know, from a higher level. So think of it like a stock option, but it's related to seller debt. And there's purchase warrants too, so they're all a little different. But in Scott's case, they were attached to the seller debt.
And how does that change the conversation or the structure if it's not 100% sale? What if it's a partial sale? Does that make any difference? Or
no, the 100 versus it's all part of the structure and can be very flexible. So it doesn't have to be 100%. The theory with the warrants are, if Scott gets paid out in his warrants, the value of that company has gone through the roof, and the participants are benefiting as well. So he's betting on himself, the participants are benefiting, and everybody wins at the end.
Okay.
And there's some unique, I won't get too far into this, but there's some unique, we'll call it wealth transfer techniques too with warrants initially, due to the low value initially. Some of you are probably familiar with that, but also another concept to keep in mind. We don't see it very much, and I'd have to maybe bring legal into some of this, but I know that's an option to use for your gift exemption and maybe get some wealth transfer to some other a selling shareholder to their kids or whatever if they're not letting them be part of the ESOP.
Yeah, we're just getting a glimpse, I think, of this whole thing in this presentation, an important glimpse. One thing that strikes me as being a wealth advisor also is that, you know, these employees are getting they don't have a lot of diversification. And if your company is small, it's they've got a high concentration of small cap exposure, if you will. And how do you address that and what are the rules about that?
Yeah, so this, I think I'm following your question. This maybe pertains more to the plan document side of things, but there is a IRS rule, diversification rule, where participants can and have to diversify at a certain age 50, and it's a certain percent of the value of that company. So there is some mechanisms put in place there from an IRS perspective or DOL perspective.
Yeah,
but, that's really the main kind of mitigating factor for that.
Yeah, thank you. And Scott, you mentioned that some of the original employees that had been with you were bought out at 6 figures. And was that all because of a concentration of the stock, or did they do that diversification process?
Yeah, so when we did the transaction, how I set it up originally, I allowed any employee to buy stock in the company. So they actually wrote a check. And that investment was, like I said, $3,000 or $4,000.
I see.
3 people, my admin, had been with me for 20 years. So they were the biggest payout, but I didn't want any of the employees to carry debt. So during this transaction, they were all cashed out of their ownership. I was the one who took the debt. So those were the ones. I mean, it just was such a cool story to me that they trusted me with a large amount of their money back in 1999 or 2000. And fast forward,
right,
they got, I don't know what that number is, 40 times their initial investment back, which is, I think, cool. And that's what I'm hoping with the ESOP, is that they're trusting me again. They're not putting any money in, but I'm hoping if they're here 5 or 10 years, that they'll sit with this pool of money in their ESOP and go, oh my goodness, this was so cool.
Yeah.
That would be my hope.
Yeah, the fractured ownership is a lot easier to structure when those other shareholders are redeemed and you're left with one, such as Scott. If you have 20, 50 shareholders, I mean, these transactions can get pretty interesting because of the different goals of all the selling shareholders.
Yeah. Sue, Brett Howells asked a question about the difference between ESOPs and cooperatives and what are the advantages of that. Is that something that's a whole nother presentation, or can you give us a 1 sentence on that or something? Is Sue on here? I'm scanning the tiles.
Maybe Kirk can answer. I guess really what I was considering more is maybe the tax implications of why would you do one versus the other. Is there a tax advantage, Kirk, to one versus the other?
I better not get too far out of my league here, but I mean, on the ESOP side or the company side, if it's 100% S Corp owned ESOP, there is no tax. There's no tax. So some of you can correct me if I'm wrong. I have worked on a few cooperatives, basically farmer cooperatives, and there's patronage and non-patronage income, where I believe the patronage income is not taxed and the non-patronage income is taxable. So there's a piece to the co-op. Now, I think that's maybe a little different than the worker cooperative, but that I'll put myself out there, and that's what I think happens with a farmer cooperative. But to the ESOP perspective, that company sponsor isn't paying tax if it's 100% owned by the ESOP trust as an S Corp.
Thanks.
That's a good question. And I think it merits a further, we can talk more about those other options. What occurred to me here is that Sue is not on the tiles, and that's what happened to her slides somehow too. There she is. She's coming back around. Welcome back, Sue. You're on mute. You're on mute, Sue.
Yep, I'm going.
There you
So
go.
sorry. All of a sudden, my computer just went blank.
Yep.
So...
We had just come to that conclusion. And speaking of conclusions, we are getting around to the end of our time here, and we had just answered some questions while you were away in the Ethernet. And I wonder if you could kind of bring this all back around in a summary of the process and your input, and answer this final question that came in. Who would be a good point of contact to start with? Some of the people on the call have clients that are interested in this, and how do they get started? And should they contact you, or how should we get started here?
Yeah, absolutely. And on the slide deck, which I'm going to send a PDF to Jessica to send out, is the contact information. But definitely contact me. And if you go to our website, MNCEO.org, we have lots of opportunities to set up a call with me, to take a look at the professionals that are listed there. And there's a company list as well. You could search by industry, by size, by location. So you could see if in your area there's another ESOP company, because talking to, as you could tell from Scott, for an owner to talk to another owner just has a lot of value to it.
Huge.
Mm-hmm. Huge. So yeah, as I said at the beginning, we really want to be a resource for, your members, for business owners, anyone out there that just, wants to narrow down the process of not having to do all the research on their own.
Yeah.
So that's what we're really there for. So I hope that when you get the slide deck, you'll have the contact information for Scott and for Kirk and for me, and would be happy for you to join our mailing list to get updates of what we're up to on a monthly basis too. So that would be great. And I appreciate. Yeah,
that'd be great. Thank you.
Yeah. Yeah, thank you. Sorry for the glitch there, but at least we got through the presentation, right?
Right. No, it was like just in time, and we're all about that. So
good.
We really appreciate everybody's remarks. Scott, especially getting up so early and being adverse about the morning like that. Thank you. I personally was inspired by your out of the box thinking in terms of employees and culture, and that getting your hands around that, I think, is something that a lot of business owners do not share equally. And so thank you for that perspective, and exactly how you did the ESOP and why it's good for your employees and why that's good for your business. And Kirk, thank you for your knowledge and explaining this complicated process to us. And we very much appreciate that. Thank you both.
Thank you. It was a delight. If anybody wants to talk to me, like Sue said, my contact information is there. I love networking and meeting new people. So I'm happy to talk to anybody, Mark.
Great. Thank you.
Thank you, Mark.
Absolutely.
Yep.
Sue, thanks for putting this together. We appreciate that. Again, Sue can be reached and she's our contact to take this further. And that's consistent with her mission. You're not compensated by that. You're not conflicted in that. Their mission is to create this opportunity for all Minnesota business owners. So
correct.
Thank you.
That's well said.
MNCEO.org.
Yeah, great.
Okay.
Thanks, Mark.
You're welcome. And I'm just getting the schedule up here. May 13th is our next meeting. We've got family business transfers, fair versus equal. Anybody in the exit planning industry knows that every business is family owned at some level, it seems like. And this is a very big question. So please plan to sign up, watch for that. Jessica will send that out along with the slides from today's presentation. So thank you again, everybody, for being here. Another great meeting. I'm just tickled. Thank you.
All right. Thank you.
All right.
Have a
Have
good
a great
day.
day, everybody.
Yeah. Thanks. Bye-bye.
Right. Bye-bye. Right.